So we're delighted to be here this morning to talk about exchange-traded funds, exchange-traded products, and the continued global acceleration and growth, specifically as we see it in Europe and how these products are poised for future growth. Future growth is really supported by a few things. One is continued product innovation, continued investor demand and education, and the continuous trend that we see from investments of passive investing, assets going from active into passive products. We'll talk about some of the obstacles and the challenges and the growth areas that we see in this panel with the panelists. But before we do that, we thought we would just kind of give a quick snapshot of where these products are in the European market today. So we end April 2017 at just about $650 billion in assets under management in European exchange-traded products. How this compares globally is we're at about a $4 trillion market. The US recently is the leader, surpassing $3 trillion in assets under management for these products. Year to date, we've seen in Europe about $40 billion in inflows into these products, which is supporting further evidence of growth. When we look at Europe, it's interesting to point out that ETFs began and were first introduced in the US in 1993. In Europe, they followed 7 years later in 2000. So if we look at BNY Mellon, we've looked at the first 16 years in the US from 1993 to the end of 2009, and we saw that assets ended just below 800 billion. If we look at the first 16 years in Europe, 2000 to 2016, assets ended at about 600 billion. So it is showing a trend that the trend is falling globally, with the advance of these products and the emergence of these products earlier, 7 years starting in the US. Specifically from Europe, if we look at where these funds are domiciled, the two leading centers of domiciliation for these products is Ireland and Luxembourg, with about 26% representing funds outside of those two domiciles, mainly Germany, France, and Switzerland. If we look at, in the discussion of this panel, will be where do we see this market going? We see continued growth. In a recent study by PwC, they said about 2021, they estimate the global market will be anywhere from 6 to 8 trillion in assets. Specifically in region, that leads to the forecast of about 1.6 trillion in assets by 2021. So certainly we see a lot of evidence of growth. So to that, we will shift to the panel of four individuals I have sitting. I'll introduce them to the right down. To my right, we have Mohamed Marati, Deputy Head, FundsPlace, Head of ETFs and Fund Settle at Euroclear. Next to him, we have Howie Lee, co-founder of Canvas, ETF Securities. Further down the line, we have Mark Harris, VP, ETF Capital Markets, EMEA Spider. And following, we have Sascha Cronemeyer, Corporates and Markets, ETF Sales and Trading, Commerzbank. So if we start the discussion, if we look at the European market being about less than a quarter size of the US market today, I'd like to ask the panel to start, what obstacles have there been to achieve more of a rapid growth? And with that, we'll start with Mohamed.
Good morning to all of you. As Jeff mentioned, ETFs are a global phenomenon, and there is significant difference between Europe and the US. And there are two major differences. First is about, on one side you have exchange and OTC trading activity happening, and I will describe later on. And the second element is the development of the retail business. And before going in detail, just to give you some ideas about Europe and US, some figures. US listing, you have 1,930 listing, 97 providers and 3 exchanges. If you compare the same in Europe, you have around 7,000 listing, you have 66 providers, and you have 25 exchanges. So that just gives you the perspective between US and Europe. Europe is a fragmented market. If you see about the trading and how to explain the trading, in the US you have some complex regulation, Reg NMS, from some of you are familiar with that, and brokers are required to trade those ETF on the trading venue. And if you compare with Europe, and if you see the figures, 70% of the trading in the US is happening on exchange and 30% OTC. In Europe, it is the opposite. You have 70% of the activity happening OTC while 30 on exchange. Why is that? Is that another element in Europe, institutional investors are investing a lot in ETF and are quite familiar with the OTC. And just to give you some figures, if you take the OTC, some of them are using TradeWeb or Bloomberg. The average ticket size is like 2.5 million. If you go on an on-exchange, it's around 200, 500, 1,000, just to give you the sense of magnitude. So you can see that Europe and the US, OTC stock exchange is a big difference. And the second element is more about the retail. In the US, the retail is around representing 40% of the activity, while in Europe is around 10%. And why is that? So one of the main drivers in the US is that people are investing themselves their own pension funds, so they have some cautious about what they do with their investment. Another element which differ between Europe and the US, as mentioned, in the US you have 3 exchanges, right? And they all settle in one place, DTCC, in terms of post-trade. And if you compare to Europe, as mentioned, you have 25 exchanges, so you can imagine how many CSDs. And we have one slide where we can just illustrate how Europe is organized and the challenge we are facing and what have been able to achieve.
So I don't think it's on there.
Okay, so there's no slide, so but we'll manage it. So visually, just follow me. An ETF is fungible at trading level, which means that I can buy on LSE, Commerzbank, a market maker, and buy from LSE, and I say the same one on etc. And the post-trade, visually, I buy on LSE, it's settled in the local CSD, EUI crest. And when I have to sell on Germany, etc., I have to sell via the local CSD, CBF. So I have to realign as a market maker from one market to another one. And those realignment, maybe on paper it seems easy, but in reality they are complex, they are costly, and they are risky. And it is what did not help the growth of the ETF in Europe, and what we have done with the industry recently. So voilà, you have the picture now. So that was the model on the left side, and what we have built with the market. So what we have said, why not to replicate the model of the US? You have, to the extent possible, not 100% like in the US, but not far away from there. So we work with the stock exchange, we work with the clearing house, and we work with the CSD to make sure to say, okay, let's create one place of settlement. So we started the journey 4 years ago, and we work with market makers, prime brokers, a clearer to make it happen. And now, after 4 years, we have 230 billion in this environment. We start getting more issuers joining. So this is what we are doing with the industry to support the growth in Europe.
Thanks, Mohamed. So we talked about market structure. We touched upon the difference of the retail and the institutional makeup from the investor perspective across the different regions. We can hear more about some of the markets trading, securities lending activities, as well as just product structures. But maybe we'll just start quickly at the end of the table to Sascha, your thoughts on some of the obstacles.
Yeah, definitely. Thanks, Mo. First of all, regarding fragmentation, I like to take that point up because I see there are actually 3 main obstacles for a market maker nowadays. That is fragmentation, first of all. Fragmentation, we have heard, compared to the US, we have much more, or many more exchanges. We have realignment cost from one exchange to the other. We are in the process of implementing international settlement, so that's the model Mohamed explained. but nowadays still we have this realignment cost, and it's not just about costs of the realignment that is maybe neglectable, but there is also the risk of having buy-ins because you are covered on one exchange and you cannot within the time frame realign to the other exchange. Therefore, this is one really big obstacle currently. Another obstacle is the misery of liquidity, because nowadays it looks like ETFs in Europe are not liquid, but that's not the case. I can assure we as a market maker, we are happy to bring liquidity to the market wherever it is needed, but as there are so many exchanges, it tends to move towards the OTC space where institutional clients ask us for quotes, and they get quotes in really big size on TradeWeb on these RFQ platforms. Nowadays the numbers are moving around, but around 70%, I would definitely agree with that, are traded OTC. And there's one last obstacle that I see currently, really a structural obstacle for a market maker. For us, it's always really good if we can lend shares, deliver to the client within the settlement cycle, and also borrow the shares back. So the lending market compared to the US is not really mature in Europe. It is really in the beginning, in the building phase currently, I would say, but we cannot rely on that. So all of that leads to more cost for the market maker, and that leads again to a wider spread on exchange. So we are not able currently to show the really good spreads that you see in the US market. But in case we can develop on these obstacles, we're definitely happy to also show tighter spreads and whenever the costs are coming down.
Thank you. So if you want to add anything.
Yeah, I think I might just add to Sascha's comment there on liquidity, and thank you for bringing that up, because I think that is a very important question. So, you know, I work at ETF Securities, and many questions that we get from investors comes from, well, is this product liquid enough? It's a new product, or it's a product that trades less on exchange. And to Mo's comment, not everything is printed. So I know there's probably quite a lot of fund buyers in this room. After all, this is the investment strategy forum. I think the first thing for fund buyers to be kind of, I suppose, aware of is, if you like an investment strategy that is wrapped up in an ETF vehicle, is to call up that ETF house to understand what the kind of underlying trading is. Because at the end of the day, the ETF wrapper is a wrapper in itself. And it is no different than, let's say, what you'd commonly do when you buy a UCITS mutual fund. The UCITS wrapper is essentially just an additional layer on top. And we talked about OTC versus on-exchange buying. And actually quite a lot of investors do buy OTC, especially when you're a larger investor at size. And OTC trading in that sense is very similar to you buying a mutual fund at an end-of-day NAV. A market maker or your broker will be able to give you a price based on that. And of course that liquidity doesn't show up. So you should be very aware that that's the ETF industry is in a state of evolution where we're trying to obviously improve the transparency of this pricing for investors. But fund buyers shouldn't be afraid to call up their product provider to make sure you understand what is the most efficient price to buy the investment strategy that you really want to have access to.
Thank you, Howie. Mark, do you want to add anything?
Yeah, I mean, just following on from all of those points, and it's true that if you look on screen at the moment, liquidity is very thin. I mean, just one quick thing is, think about the underlying constituents of the product you're buying. That's how liquid your ETF is going to be. So if you wanted to buy 100 million of an S&P 500 ETF, it's super liquid. It really isn't a problem. So the way to look at it really is go beyond what you see on screen. Think about the product. How easy would it be for the portfolio manager to invest that cash, and what would be the impact of investing that cash? So that's definitely something that we try to educate a lot of our investors on.
And in addition to that, ETFs could even bring more liquidity to the market to a certain extent. Secondary market liquidity, or market makers have inventory, might bring even tighter spreads than the underlying spreads, just for under normal market condition, I have to admit.
I suppose that's where the interest in fixed income ETFs has really been driven from. Yeah, that additional layer of liquidity.
Sure. So as we shift from speaking about some of the challenges to the opportunities and going back and benchmarking the study that was mentioned of assets getting to about 1.6 trillion in region by 2021. So a lot of times, a lot of the challenges can become opportunities because there's always an evolution of trying to solve those challenges. So if we start with that and we look at, like to get the panel's take on where we think the opportunities in this space are for further advancement, if it is through the increase in product strategies as we've gone from market cap weighted trackers to more of products that invest in commodities, leverage, smart beta has been a focus of time. If we go from regulation, so we talk about MiFID II, and we talk about in the UK, the previous RDR, T2S, or if we talk about really how we will advance in Europe the retail usage and getting more of the retail users and the historical distributors in Europe to utilize and push ETFs more, because that has led to a lot of the successful distribution and asset gain in other markets, namely the US. So, Mark, why don't we start with you and your thoughts on some of these opportunities?
Yeah, sure. So I think there's the real key for continued expansion of ETFs in Europe is diversification of the investor base. So I think we've touched on securities lending and the fact that in Europe at the moment it's pretty much flat. However, we have seen real growth in the amount of ETFs that are available to lend, and also the awareness that you can actually lend an ETF. Additionally, we see more usage of institutional clients and some of the bigger investment banks looking to use ETFs for collateral. And you see a lot of third-party lenders, etc., now that are willing to accept ETFs as collateral. So why is a securities lending market for ETFs important? I mean, Sascha touched on a couple of points. Firstly, it's pricing. Lending will add liquidity to the market. For market makers, it's important to know that should there be a failed trade, they have access to readily available inventory that they can satisfy their trade, avoiding buying costs, etc. So it would have a positive impact on spreads, firstly. Secondly, it will attract new clients. So guys that want to take a more strategic view on the short side will be able to use the lending mechanism to enable them to execute that tactic. And lastly, I think it's important for investors to recognise that by lending the ETFs and gaining revenue from that activity, you're offsetting your total cost of ownership. So it really is a win-win, and it becomes very cyclical as a positive. And secondly, from a new client perspective, I think definitely myself, I've spoken to more and more traditional fixed income management companies where the use of ETFs perhaps 2-3 years ago just wouldn't have been on the agenda. Traditionally, there have been bond buyers, long bond buyers. I think developments in regulation and making it a little bit more difficult for those guys to show diversification. Some challenges on accessing the bonds and price discovery make ETFs very attractive now in that space.
Also, what I could add to Mark's comment is that if you compare US and Europe, you have a lendable ETF pool. So in the US, 25% to 30% is leverage, while in Europe is 5%. And also, when you see those graphs, you can understand that in Europe today, in the traditional model, the pool is fragmented within different CSD. With the new model, everything is in one place. Agent lenders can see their available pool, and now when they discuss with market makers, they can have a good view, because in the past it was different ISIN codes, so they didn't have a view. And now we started to see some growth in that area, and we start seeing some activity picking up. We have our own securities lending in our system, and we start seeing market maker and lenders doing some activity in our system.
I suppose, both Mohamed as well as Mark kind of highlighted the improvements and what you're seeing in the ETF ecosystem. And no doubt that's a great thing for investors, because at the end of the day, this leads towards improved cost in buying and selling the underlying product. And with this kind of growth in the usage of the products and the more users, I suppose taking a different perspective is looking at, okay, well, what kind of other fund types or strategies will start coming into an ETF wrapper. It's amazing how over the last 5 years I've noticed a big shift in the types of products which houses are considering to offer their clients. It's a big recognition as to where the asset management industry is going. There's a lot more emphasis, of course, on asset allocation, multi-asset funds, and a lot of our buyers, for example, are indeed multi-asset funds or asset allocators at wealth managers. And there's certainly a few areas of growth where I'm going to highlight as, and very much driven by investor feedback, needing more products in fixed income. A lot of strategies at the moment, both on the active as well as passive side, is looking and tracking the kind of the main benchmarks that are started by, say, Barclays, now owned by Bloomberg, and there's a move away from that, and we touched on that as a firm doing fundamental fixed income a couple years ago. But another area that actually surprised us as well, and again, this shows the development within asset management industry. More and more asset allocators are now carving out a portion of their portfolio to allocate to thematic investing, so megatrends, long-term themes, things which are uncorrelated with views within their kind of core portfolios of equities and fixed income. And so you see huge growth in that. And for us as a house, we've actually seen the most attention, I would say, in the last 8 months around this kind of long-term themes. The ones that we focus on are very much on the robotics and cybersecurity side. But for me, probably the biggest growth, and no one really talks about it enough, is around the alternative space. So I continue to hear investors need to diversify their returns, uncorrelated returns, so that they're not exposed to some sort of spike or downturn in the equities or fixed income markets. And I think there's a lot more that can be done in the alternative space. ETF vehicles generally are in a UCITS wrapper. If it can be in a UCITS wrapper where you're providing some sort of absolute return or market neutral, it seems like that's where investors want. So I think there's going to be a lot of opportunities for ETF, I suppose, participants to service the asset allocators, which are certainly in this room. And I think that is also matched by some of the regulatory drivers that were touched on. We're starting to see structured products, which tend to hang around the investment banks, leaving the investment banks themselves and trying to find a home for their structures. Banks themselves find it more and more difficult, I think, to offer products like they used to, and will continue to work with asset managers, ETF providers, to launch these kind of structured product-like indices or systematic quant investing products in the ETF space. So I think for us as industry participants and servicing the asset management industry is making sure that investors are aware there are developments and opportunities in the space. And personally, I see it very much anything that can be wrapped in to a systematic rules-based strategy based on quant, based on the magic words of machine learning. You'll see a lot of development in the ETF space there.
Sure. So we talked a little bit about the trading of ETFs and trades off exchange not being reported. Sascha, focusing on trading, if you can comment on regulation, for example, like MiFID II, and how you think that will help show a consolidated view on screen of ETF's true volume.
First of all, I'd like to take up one other point. We have talked about institutional clients and about that institutional clients' new products are common to the market and therefore bringing growth. One other thing, and MiFID is also kicking in there, is the retail space. So that's another completely new segment that is that is coming up, and we're seeing that there seems to be a lot of room left if you compare it to the US, what Mo in the beginning did. And MiFID, RDR, those kind of regulatory movements are bringing or giving the ability for retail investors to more and more use ETFs, and also education is at the moment kicking in, and we have developed some trading models just behind or for the retail platform space, and I think that could even be a really, really big growth driver in the coming years. MiFID, and that was your question, MiFID, in terms of tick sizes and those kind of regulatory schemes would definitely bring two very important things, and that's liquidity to the exchange. And what I've learned at university is liquidity attracts liquidity. So whenever more liquidity comes to exchange and is visible via consolidated tape, for example, it will definitely help the overall market, and in combination with an ICSD, international settlement model, I think even the spread will tighten in the coming years.
So just a point, sorry, to labour the regulatory points, but just under MiFID II, which is now scheduled Jan 1st, and executable the 3rd, right, I believe. So what you're going to see is there's regulations that you can still trade ETFs OTC. It does impact market makers in doing that with the SI rule, systematic internalizer. But the big thing to take away is that whether you trade on screen or OTC, everything will be printed. So you will see the whole spectrum of liquidity in an ETF. So largely, for once, from a provider perspective, we are fairly bullish on MiFID II and the visibility it's going to give to the end investors.
This is one point I would like to add on Sascha's comment on the retail side. I mean, we have all seen, the shift from active management to passive management. And the recent years, we have starting to see as well, mutual fund distribution house, they start putting their ETF as well as available instrument in the platform. So you can see that issuers are working to make sure that their products can be distributed to the retail, and now mutual fund distribution channel are also leveraged. And we start seeing some development in that regard as well.
Yeah, and I think that supports, kind of the conclusion here is I think we all agree, as many people in the industry, that ETFs are poised for significant growth. In Europe, there's a $14 trillion mutual fund industry, and as platforms, awareness, market structure, regulatory changes, we do expect more of those assets to flow into these lower cost vehicles. I do think the one important thing to also remember is that, when we talk about an exchange traded fund or product, we're really talking about a wrapper, a structural wrapper, and that word was used today to deliver a strategy across many different asset classes. And so it's not just a traditional, cap-weighted tracker to a very large popular index. They are now offering exposure across asset classes and using multiple factors outside of cap-weighted. And I think supporting the advance of the assets as well as, flow, particularly into the retail investor, which tends to be more of a longer buy and hold investor. S&P put out a recent study that showed, index versus active, and it showed in Europe, 84% of active managers have failed to beat their benchmark over a 5-year period, and that went down to 64% over a 3-year period. So it does demonstrate that for a retail buy and hold investor, long-term ETFs are poised to deliver increased performance. I know we're running a bit over time. There's a couple sections within this track, but I think if we have time, we'll take one question before we depart. If there are none, then thank you very much to the panel to join, and thank you for being attentive during this discussion.